Hey, welcome. So, in the world of finance, there's this constant battle happening right out in the open. It's a fight between two huge forces that pretty much decide the fate of every public company. On one side, you have the price you see flashing on your screen, and on the other, the real value that's kind of hidden underneath. This fight makes or breaks fortunes, and today we're going to break down exactly how it all works. And that brings us to maybe the single most important question in all of financial management. When you look at a stock ticker, is that number, the one blinking green or red, what the company is actually worth? Well, the answer is way more complicated and honestly a lot more interesting than you might think. So you've got two big ideas here. On one side, you have the market price. It's just an observation, right? It's a fact. It's what somebody is willing to pay for one share at this very moment. But on the other side, you have intrinsic value. Now, this isn't a hard fact. It's an estimate. It's a careful calculation of what the company is fundamentally worth, based on its power to generate cold, hard cash. And that whole idea about cash, it's all based on the absolute bedrock principle of all finance. The value of anything, a whole company, a bond, even an apartment building, is just the present value of all the cash it's expected to kick back to its owners over time. That's it. That's the big rule. Okay, so keeping that core rule in mind, let's officially kick off this first section and really dive into this conflict, price versus true value. All right, next up, let's talk about who's actually in charge of creating this value in the first place. Let's meet the architects inside the company. So at the very top, you've got the board of directors who are kind of overseeing the whole show. They're the ones who appoint the CEO, who then sets the vision. And reporting to that CEO, you've got two really critical players, the chief operations officer, who handles the day-to-day business, and the chief financial officer, who, you guessed it, manages the money. A really great way to think about this is that the CEO and the CFO are basically the two hands of the CEO. One hand, the COO, is actually building the product and running the factories. The other hand, the CFO, is managing all the capital and talking to investors. Put them together, and that's how a vision becomes a reality. But see, these leaders, they need a really powerful structure to pull in the huge amounts of money it takes to grow. That structure is the corporation, and it basically has three superpowers. First, it has an unlimited life. It can keep going long after the founders are gone. Second, you can transfer ownership in a split second. And third, and this is the big one, it gives investors limited liability. That last superpower is the secret sauce. It's what gives millions of people the confidence to risk their money and invest in the first place. Okay, now we get to the real heart of our story. This clash between the cold, hard truth of how a company's doing and what the public thinks is happening. Let's really dig into this difference we talked about earlier. Intrinsic value is all about the long run. It's based on true cash flows and true risk, the actual numbers you can verify. The market price, though, that's a short-run thing. It's all based on what the public perceives those cash flows and risks to be. So when we say true value, what we're really talking about is an analytical calculation. It's what the company should be worth if you ignore all the noise and just look at its fundamental performance, its real earnings, and its actual competitive strengths. Now, perceived value, that's a whole different ballgame. It's all about psychology. It's the story the market is telling itself about the company. And that story is driven by news headlines, analyst ratings, even tweets. Really, the overall mood of the market. And check this out. This is where it all comes together. At the very top, you have one set of actions from the managers. But those actions create two separate streams. One stream is reality, the true cash flows and risks. And that's what creates the intrinsic value. The other stream is all about perception, and that's what creates the market price. Now, in a perfect world, the goal is for these two streams to meet up. We call this market equilibrium. It's this ideal state where the market price is a perfect reflection of the true intrinsic value. But, of course, we don't live in a perfect world, do we? And that gap, the space between perception and reality, well, that leads us straight into the messy, real-world human conflicts that really define corporate life. So you gotta ask, right? If intrinsic value is the truth, why would a manager ever focus on anything else? Why would they chase that short-term market price? Well, it's pretty simple, because managers are human, and humans tend to act in their own best interest. So the system has four main tools to try and keep everyone focused on the same goal. First, you can tie their pay to long-term results, not just this quarter's stock price.
Second, you let huge shareholders step in and make some noise. Third, the board always has the power to fire them. And finally, there's the ultimate form of market discipline. If that stock price drops too low, another company could swoop in for a hostile takeover. And then everybody in the C-suite is looking for a new job.
But it's not just about managers versus owners. There's another huge conflict baked into the system: the people who own the company versus the people who lend it money. See, stockholders, the owners, they often want the company to take big, risky bets, because if it pays off, they get all the profit. But debt holders, the lenders, they absolutely hate risk. They just want their fixed payments back on time, so they'd much rather see safe, stable projects. So, to protect themselves, lenders build these legal guardrails right into their loan agreements. They're called covenants. A covenant might say something like, hey, you're not allowed to sell off your most valuable factory, or you can't take on a mountain of new debt without our permission. It's basically their way of stopping the owners from getting too reckless with their money. So with all these different people pulling in different directions, what should a leader's ultimate goal actually be? Well, that brings us to our final section, the ethical North Star. After you navigate all of these conflicts, the guiding principle becomes crystal clear. A true leader's North Star isn't that flickering light of the daily market price. It's the steady, constant goal of maximizing the company's long-term intrinsic value. And this leads to a really profound and honestly an often misunderstood idea. A lot of people think maximizing value is all about being greedy. But it turns out being socially responsible is not inconsistent with maximizing shareholder value. And why is that? Well, think about it. A company that mistreats its employees, pollutes the local river, or cheats its customers is eventually going to pay the price. Its reputation will get trashed, customers will walk away, and regulators will hit them with huge fines. Every single one of those things destroys a company's true long-term ability to generate cash. So the next time you see a stock price flashing on your screen, ask yourself, what's the perception story here, and what's the truth story? Far away from all the daily noise of the market, what real, durable value is that company actually building?